technology stocks as we're still getting mixed signals on a tariff reprieve. The rest of the Hang Seng heavyweights, namely technology names, are doing this. And in the meantime, let's pivot to the mainland markets right now. And of course, we did see gains. We are looking at the gains coming through. Shenzhen Composite for one higher by 1.3%. And we're very much focused on the Chinese yuan. We did see the midpoint fixing coming at the weakest level since September 11th of 2023. But we also saw March credit numbers showing some expansion as well. So maybe this is something that the markets could be reacting to as we speak. And we've got consumer electronics index in China set to open up by more than 2%. Marty?
Yeah, and Sherry, you need to note that about 15 minutes ago, a little bit more than 17 minutes ago, we had the midpoint fix for the RMB expected at 732.51. In the event, it ended up being 21.10. But as you referenced, that is the weakest since September of 2023. I also want to alert viewers to the fact that the trade-weighted CFETS basket, RMB basket, is at 96.61, which is the lowest since July of 2023. So, I'm not sure. It sounds as though they're trying to shore it up more than anything else. But we had a guest earlier on, Sherry, you'll remember, Gary Evans from over at BCA Research, talking about the yuan this morning. And he expects a 10% drop in the value of the renminbi versus the dollar within the next 6 months. Here's some of what he had to say. Take a look.
Back in 2018, the renminbi weakened 16% against the dollar. Now, this time the tariffs are so big that it's not going to be enough to offset them, but a weakness allowing the currency to depreciate, at a slow pace makes sense. So we're talking about 8 over the next 6 months. That's about a 10% depreciation from where we are today. And so that's also got some implications, of course, for other currencies in emerging markets, particularly those in Asia, because they tend to move in line with the renminbi.
Let's get value add. Bring in Chen Zhao, Chief Global Strategist at Alpine Micro, joining us all the way across in Montreal, where he's, I guess, relatively safer from all these tariffs. Chen Zhao, great to see you, and always appreciate your time. Listen, this 10% depreciation call from Gary Evans, who we talked to earlier from BCA, within the next 6 months, is that pretty wild, or is that potentially possible?
I think the surprise could be that actually the renminbi is not going to depreciate that much. The reason for that, actually, if you look at history, any countries that actually hike taxes or ease monetary policy usually end up with a weaker currency. Any country that actually doing fiscal expansion usually come with a stronger currency. Think about the United States in the early 1980s, when Paul Volcker came to the Fed and really jacked up interest rate, and then Reagan cut taxes. So that actually produced a very strong currency. So I'm thinking right here, the consensus call seems to be that the Chinese currency is going to go down. But I'm saying, hey, this tariff war, first of all, completely make no sense. Secondly, actually probably going to accelerate China's fiscal expansion. If that's the case, actually you may actually lay a foundation for a stronger currency. That could be a big surprise. I think right now everybody was looking for one direction, which is a weaker Chinese currency. I don't think that is going to. Yeah, go ahead.
A stronger renminbi. So this is interesting, Chen Zhao. So let me try and connect the dots here. If China were to weaponize its holdings of U.S. Treasuries, and it is probably the second biggest holder of U.S. Treasuries right now, right? If it were to either slow down buying, which is what they have been doing over the last couple of years, or stop buying, or potentially even sell their holdings of U.S. Treasuries, that would eventuate in a stronger renminbi as well. Is that what you're expecting too?
Yeah, I don't think that they are that silly at this point. I think they are actually weaponizing the Treasury holding already. Think about this transaction here. Most of the China sovereign funds actually have operation in Europe. What they can do is not necessarily sell dollar to buy the Chinese currency renminbi. What they can do is very simple. They sell U.S. Treasury and convert the proceeds into the euros or German bunds. That's actually very consistent with what happened over the last couple of weeks. Well, actually last week, you have a very weak U.S. dollar, very strong euro. You have a Treasury yield that actually moving up, and then German bunds actually are coming down. That is, to me, somebody is selling the Treasury and convert the money into the euro-denominated assets. I suspect that a big chunk of that actually is a Chinese operation right here.
So you don't see the U.S. Treasuries coming back, returning as a haven asset for the foreseeable future?
I think for the time being, I think there's a very dicey situation right here. First of all, we don't know the liquidity condition. We know there was a piping problem because all this money managers last week, there's a mad dash for cash. Everybody wants to redeem their treasury bonds and in order to get the liquidity to get their to make up their losses in the stock market. Right now, I think this is getting better. But I think right now the bond market is still in a state of uncertainty because they don't know how to price the trade war. Is that inflationary, deflationary? What is the story? You can make both cases. That's why I can see this bond market is very wonky at this point. I don't think you can have a bond crisis as a so-called Lee Strauss moment, because in the end, the Federal Reserve has the ultimate power, the card. They can come in and monetize and buy Treasury bonds. But in that case, it's going to be very dollar bearish. So it's not a straight story at this point. I don't think that anybody can make a determination. Not only you, me, not even Fed can make a determination right now. The bond market is in the repricing process, or bond market is in trouble. I don't think they have made that determination yet.
What's happening in China's bond market? Because the conversation last year was this massive rally, even to the point where the authorities were worried about some of the retail investors getting, squeezed out in case things turn around for the better in the Chinese economy. What's your outlook on that front?
I think the Treasury Chinese bond yield backed up a bit because this is very consistent with the sort of a bit of an optimism that the physical expansion finally has come. And last year you can see the yield just keep plummeting because there was a pervasive pessimism that the economy is soft, deflation is spreading. And yet the Chinese government is reluctant to do anything. And then this year, the Chinese government has had a conference with all these private entrepreneurs. At the same time, the government has made it very clear that they want to do physical expansion. So all of that actually triggered the stock market rally, and actually bond yields actually backed up. So the bond market started to weaken a bit. That is all consistent as one same story. So I would say right now, if you look at bond yields, we're pretty steady, even 1.6, 1.7%. It is consistent with the view that actually, yes, the tariff war is going to hurt Chinese economy, no question about it, but it's not an existential threat. Be careful here. The leverage is on both sides. You can see that Trump already blinked because lots of Chinese exports to the United States are non-substitutable. So if you put up tariff at 140, 120%, you basically cut the bilateral trade to zero, and that actually caused massive problem for the United States because 2/3 of the Chinese exports are done by the companies that are partially owned or wholly owned by the United States, by American companies. So actually, yes, you're going to hurt the Chinese employment, you're going to hurt Chinese economic growth, but they're going to massively hit the U.S. profits. You can see that is all happening. So this is like the leverage is on both sides and equally powerful. When you think about these two economies over the last 30 years generate 60% of the world GDP together, you have a sustained disinflation, sustained lower interest rates, very, very big profit in the United States. If you're trying to dislodge these two economies, I think the dislocation on both sides is going to be pretty massive. I think Trump now starts to realize that, which is good and positive thing in my view.
All right, and this is why he blinked, is what you're suggesting, Chen Zhao.
He blinked at me. Yeah. He said, every whole world leaders are lining up to kiss his butt. That's what his word.
Okay, listen. Okay, well, listen, I mean, the official messaging from Trump is that, look, still thinks Xi Jinping is a great guy, a great leader, etc., and he thinks that China wants to make a deal, just that they don't know how to do it, to paraphrase him, right? Is that really true? Because I've seen some reports suggesting that China actually made several overtures to the U.S. to try and avert or head off this trade war, right? But they were rebuffed, suggesting the U.S. is kind of playing hard to get. I mean, look, who really knows, right? You're sitting in Montreal. I'm sitting in Singapore. Sherry's sitting in Hong Kong. And I wish we were all sort of flies on the wall in Beijing somewhere, but we're not. But what do you think is really happening in terms of these negotiations?
I think the Chinese government probably trying to make some compromise. Actually, this has been going on for years. Even under Biden administration, they always trying to play defensive, try to play good. But I think at some point last year, they made up their mind. They concluded that no matter how much compromise they want to make, the Americans are going to tighten the screw on them, regardless. So this is more of a strategic problem. It's more of a geopolitical problem. So. And then that's basically their conclusion. Then you can see their trade surplus with the United States is just coming way down. You can see that they try to reorient trade, trying to explore new markets, trying to reduce import from the United States. So they have already done a lot of preparation for this kind of a disengagement. You can see right now the Chinese bilateral trade surplus with the United States as a share of GDP is about 1.5%. So if you cut the trade to zero, the hit to the Chinese GDP is about 1.5%. That's what I'm saying. It's a big hit. We're talking about a third of the Chinese economic growth, 1.5%, right? When you think about 5% versus a 1.5%, it's a big hit, but it's not existential. They can make it up through physical expansion. So that's what I'm saying. They prepared this. They prepared for this for quite some time. That's why Xi Jinping is very firm. He said, "Hey, sorry, I'm not calling you." You try. Yeah. Actually, Trump wanting him to call him, but Xi Jinping said, "Hey, sorry, there's no sign that he's going to call him whatsoever." Yeah. So that's my sort of. Reckoning is. I don't believe that's going to be the case. Eventually they're going to talk. I have no question about that. When, under what circumstances, I don't know. Maybe multilateral summit of some kind, maybe G20 or whatever. They bump into each other. They shake hands and say, "Hey man, let's sit down. Let's work it out." That's most likely scenario. I don't think he's going to call him and bagging a deal from the United States. It's a politically impossible for Xi Jinping to do.
All right.
Yeah, and mutual respect seems to be a key factor for Beijing as well. Chen, it's great to have you on. Thank you very much for your time. That was Chen Zhao of Alpine Macro. And we've got some interesting flashes from President Trump. He is saying that tariff rate for semiconductors will be announced over the next week. This is something that the market should have been bracing for. We just didn't really get that, or the market was too busy digesting country-specific reciprocal tariffs. But he is saying that semiconductor tariffs will be in place in not so distant future, and also saying that he doesn't think a foreign company should control U.S. steel. So this is a conversation that we should be having with Lin, of course, talking about the fate of the deal between Nippon Steel over in Japan and U.S. Steel. He's also adding some lines around semiconductor tariffs, saying that there will be flexibility on some companies on semiconductor tariffs, but it's not clear. So it certainly looks like he is pivoting or easing or blinking to a degree that he can still say that we're coming in hot, we're coming in with maximum pressure or maximum negotiation power, but definitely goes to show that he is mindful of the consumer impact and market impact, and we'll see what kind of developments are in store for us over the next week. In the meantime, we've got President Donald Trump aiming to bring manufacturing back to the United States with his tough tariff policy, but higher costs are weighing on producers. CNBC's Courtney Reagan takes a closer look at the tariff impact on the denim trade.
I'm at Texas Los Angeles Denim and Knit Factory, where it manufactures goods for brands like Levi and Ralph Lauren, J. Crew, Madewell, New Balance, Bass Pro Shops, and many others. Currently, 12% of its production is done here, 88% in Vietnam. The goal is for 20% of its production to happen here. Founder and CEO Sanjeev Ball started building this Los Angeles facility during COVID. It took around 3 years and $25 million to get it up and running. This factory makes mostly higher price point, small batch or test runs of denim and knit garments. If what's made here resonates with consumers, bulk orders are then made in Vietnam because of the cost differential. The average retail price consumers pay for a pair of jeans made at this facility is $250. The same pair made in Vietnam is $100. Texas starting hourly wage here in LA is $16.50. It's $1.50 in Vietnam. There are 250 workers here, 3,200 in Vietnam. It takes 20 minutes to make a pair of jeans here, 16 minutes in Vietnam because of piece rate incentives, which are banned in the U.S. All in, it's 3.5 times more expensive to make the same pair of denim in the U.S. compared to Vietnam, at $70 versus $20. But Ball says the 80-20 hybrid production model brings the average cost down to $30. He believes his model makes financial sense and can be scaled and replicated by others, but not at the April 2nd announced 46% tariff rate.
What I was asking the administration for is create a preferential system where, companies like us get incentivized with the preferential rate of tariff. So probably it would just be that 18% and 10, whereas other companies would be at 18 plus 10 and maybe another 10 or 15, whatever the administration decides.
Ball says he hasn't made any major changes to production or deals with clients since the April 2nd announcement. Just like everyone else, he's waiting to see what happens next. Courtney Reagan, CNBC Business News.
All right, as we tail out into a break, take a look at the biggest movers about 20 minutes into trade up in Hong Kong. Those are some of the names. Quick break. We are right back after this.
We speak to the world's most influential people.
I love what I do, and it means so much to me.
From celebrities.
When we took a break, I thought